In financial history textbooks, January 21 and 22, 2026 will be circled in black marker. These 48 hours were not just a period of high volatility. They became a biopsy of a dying financial system. While your eyes were glued to Donald Trump's Greenland Gambit, while you discussed the NATO ultimatum and the threat of 10% tariffs on Europe, a tectonic shift occurred in the markets that most missed. You were watching political theater. You should have been looking at the physics. In the shadow of the diplomatic scandal, while Trump threatened Berlin and Paris only to switch from wrath to mercy in Davos, the silver market sent a distress signal. We didn't just see growth, we saw panic. Quotes smashed through the all-time high, reaching $95.89 per ounce. The media will tell you this was speculation on fear. They will talk about safe havens and hedging trade war risks. But when Trump announced de-escalation and the price crashed back to $91.80, Wall Street analysts exhaled, "Phew, close call, just a correction." They are lying. Or worse, they are blind. This was not a correction. This was a margin call on reality. What happened over these 2 days is a classic pump and dump scheme triggered by news, but it exposed a far more terrifying truth. There is no physical metal in the market. Let's cut through the noise. Forget Greenland. Look at the naked facts that Bloomberg hides on page 5. For the first time in decades, the futures curve has gone into severe backwardation. Do you know what that is? It is an anomaly. It is a state where metal for delivery today costs more than metal for delivery tomorrow. In a normal world, this doesn't happen. In a normal world, you pay for storage, so the future price is always higher, contango. But today, buyers are willing to pay huge premiums just to get a bar in their hands right now. They are ignoring exchange quotes. They smell the stench of exchange default. Why is this happening? Because the buyer has changed. Forget the investor buying a silver coin to hide it in a safe from inflation. The new buyer is not a human. It is a robot. We have entered an era where silver is no longer money. It is the blood of technological civilization. Look at the solar energy sector. Photovoltaics are already devouring more than 15% of the entire global silver supply. And this figure is growing exponentially. But that is just the beginning. A new player has entered the stage whose appetite cannot be sated: artificial intelligence. Data centers, next-generation chips, precision weapons, all require silver because of its unique electrical conductivity. You cannot build a green future without silver. You cannot train neural networks without silver. You cannot launch a cruise missile without silver. And here lies the main trap for the West. Demand from these sectors is price inelastic. What does that mean? If you are buying a silver ring and the price jumps to $100, you will refuse to buy. You will wait. But if you are Samsung, Raytheon, or Tesla and you need silver to produce a chip that costs $5,000, you don't give a damn if an ounce of silver costs $30, $90, or $500. You need the metal so the assembly line doesn't stop. You will pay any price. Industry continues purchasing even at prices above 94 zeros. They aren't stopping. They are vacuuming the warehouses. Over these 48 hours, we saw how fragile this balance is. The silver market has been in a structural deficit for the 4th year in a row. Stockpiles at COMEX and LBMA are melting. Traders see the spread growing between the price on the monitor screen and the price of a real bar. This is called the reality gap. The Greenland crisis was merely a catalyst. It showed that it takes only a hint of logistical disruption for panic to set in. Consumers understand, if supply chains halt, no paper contract will save them. And while retail investors in the US and Europe get scared of volatility and lock in profits on the price pullback, on the other side of the globe, a quiet, methodical operation of asset extraction is taking place. Asia is not selling. Asia is buying. We see huge premiums on the Shanghai Gold Exchange, SGE. China is paying more than the world market. India continues to buy metal despite historical price highs. For them, silver is a strategic resource necessary for dominance in the 21st century. China has already introduced export controls. They are closing the doors. Metal enters the country and does not leave. This is the fragmentation of the global market. The Western investor looks at the RSI chart and sees bearish divergence. He sees a double top. He sells because that is what is written in the technical analysis textbook. The Eastern strategist looks at warehouse stockpiles and sees emptiness. He buys because that is what is written in the textbook on warfare. The macroeconomic background only adds fuel to the fire. U.S. jobless claims data came out shockingly low, 198,000. The labor market is overheated. This unties the Fed's hands. Rates will remain high for longer than you think. The yield on 10-year treasuries jumped to 4.26%. The dollar is strengthening. In the old paradigm, this should have killed metal prices. Silver is a zero-yield asset. Why hold it when bonds give 4%? But silver held above $90. Think about that. The dollar is rising, rates are rising, geopolitical tension has subsided. Yet silver costs 3 times more than it did 5 years ago. This means only one thing. Monetary factors are ceasing to work. The physical deficit outweighs everything. We are witnessing the end of the era of paper pricing. In the next part, we will dissect the mechanics of this catastrophe. We will look inside the industrial machine and see numbers that will give you goosebumps. Because the deficit is not a forecast, it is a mathematical fact. And when the music stops, there won't be enough chairs for everyone. Stay tuned. Welcome to the engine room of the global crisis. In part 1, we said the silver market sent a distress signal. Now, let's disassemble this signal down to the atoms. Turn off your emotions. Forget what the talking heads on CNBC are saying. Right now, we are going to speak the language of the only science that cannot lie, the language of the mathematics of deficit. You must understand one fundamental thing. The world we live in is built on the lie of infinite resources. We are told we can print as much money as we want and build as many factories as we want. But there is the periodic table, and you cannot negotiate with it. You cannot sign a framework agreement with it like Trump did with NATO. Silver is the Achilles heel of the entire modern civilization. Why? Because it is the most electrically conductive metal in the universe. Better than copper. Better than gold. Without it, electric current meets resistance. In a world of high speeds and artificial intelligence, resistance is death. The 3 horsemen of the deficit. Let's look at the numbers published in these last 48 hours. They are frightening in their frankness. Solar energy. The photovoltaic sector is already consuming over 15% of the entire global silver supply. Think about that. One single industry takes 1/6 of the planet's entire mining output, and this share is not static, it is growing. The green transition they love to talk about in Davos is actually a silver transition. Europe, deprived of cheap Russian gas, is panically building solar fields. But every gigawatt of green energy requires tons of precious metal. Artificial intelligence. If solar panels are old news, here is the black swan no one expected. Reports from January 24 and 22 confirm the boom in data centers and next-gen chip manufacturing has created a new layer of demand. The servers running neural networks get hot. They need efficiency. They need silver. Do you think NVIDIA is growing because of code? It is growing on physical infrastructure that is impossible without argentum. The military-industrial complex. Amid global instability, silver consumption is rising for the production of precision weapons and aerospace technology. There is silver in every Tomahawk missile, in every spy satellite, in every drone. And unlike a smartphone, the silver from an exploded missile does not return to the market through recycling. It disappears forever. The trap of inelasticity. Here we approach the scariest concept in economics, which explains why prices will soon fly into the stratosphere. It is called inelasticity of demand. Listen closely. Industrial demand for silver is inelastic. What does this mean in practice? Imagine you are manufacturing an iPhone or a guided missile. Your product contains 50 cents worth of silver. If the price of silver rises 10 times to $300 per ounce, the cost of silver in your product becomes $5. Will you stop producing a missile worth $2 million because a component got $4 more expensive? No. Will China stop building solar stations on which its energy security depends? No. This is exactly what we observed over the last 2 days. Even when the price broke $94 industry did not stop purchasing. They continued to buy. They don't care about the price. They need the metal. This creates a situation where the price can rise infinitely until it kills demand. But demand cannot be killed because there is no alternative to silver in electronics. The empty safes. Now, let's look at the other side of the scale. Supply. The situation here is even worse. Data received during the reporting period points to a deepening structural deficit. The market has been in a state of chronic supply shortage for the 4th year in a row. We aren't just consuming everything we mine. We are eating through stocks accumulated over the last 50 years. Look at the vaults of COMEX and the London Bullion Market Association, LBMA. They are recording outflows of physical metal. These aren't just numbers in a terminal. These are emptying safes. Over these 48 hours, the spread between the spot price, paper price, and the physical delivery price has grown. This is an indicator of distrust. Large players are taking the metal because they fear exchange defaults. They know, when the real panic starts, a paper contract will be worth less than the paper it's printed on. The siren call, backwardation. And here it is, the main siren signal that should force you to wake up. Backwardation. The futures curve has flipped. Prices for delivery today have become higher than prices for delivery in the future. This is an anomaly. This is the market screaming for help. It means consumers are ready to overpay any amount for immediate receipt of goods, ignoring storage costs. In a normal market, this doesn't happen. In a market standing on the edge of a cliff, this is the new normal. The great optical illusion. But what is the crowd doing? The crowd looks at the price chart and sees a drop. After Trump's speech in Davos and the release of unemployment data, 198K claims, the price fell from the historical high of $95.89 to levels below $92. The bears are rejoicing. RSI shows divergence. Technical analysis screams sell. But this is a trap. It is an optical illusion. While speculators dump paper silver, reacting to the strengthening dollar and rising bond yields, the physical market is being cleaned out. We see a vacuum. Remember the tariff threat? Markets got scared of broken supply chains, and although Trump canceled the tariffs, the fear remained. Manufacturers realized logistics are fragile. Globalization is dying. Today, tariffs were canceled. Tomorrow, a blockade will be introduced. Therefore, they have shifted from a just-in-time strategy to a just-in-case strategy. They are building strategic reserves, the Eastern Wall. And who is taking advantage of this correction? Smart money, and more importantly, Eastern money. While Western ETFs like SLV record outflows of nearly $700 million, Asia continues to buy. High premiums on physical metal persist in China and India. This is arbitrage that sucks silver out of the West and sends it to the East. The West is selling its strategic reserves at suppressed prices to lock in paper profits in dollars. The East is exchanging overvalued dollars for an undervalued strategic resource. This isn't trading. This is a redistribution of power. China has already tightened export controls. What gets into China stays in China. They are building a wall of silver, behind which their industry will be safe when the West faces resource starvation. We are at a bifurcation point. On one side are financial markets that believe in a soft landing for the U.S. economy. GDP now forecasts 5.4% growth and a strengthening dollar. These markets are selling silver. On the other side is real industry, which sees empty warehouses and growing demand from AI and the military-industrial complex. This industry is buying silver. Who will win, paper or rock? The answer is obvious. In the long run, physics always beats finance. You cannot print silver. You cannot short a deficit when you need metal to produce a chip. If we rise above the charts and look at the geopolitical map, the picture becomes frighteningly clear. What we are observing is not just a market correction. It is the greatest strategic wealth transfer in history. And it is happening right before our eyes, while Western media discusses politicians' tweets. Checkers versus Go the West is playing checkers, while the East is playing Go. Look at the absurdity of the situation. American banks and hedge funds, scared by strong labor market data and hawkish Fed rhetoric, began mass dumping paper silver. They saw the dollar strengthening and bond yields rising to 4.26% and decided they didn't need metals anymore. In just a couple of days, nearly $700 million was withdrawn from the largest fund, SLV. They are selling to lock in profits in fiat currency. But who are they selling to? Who is on the other side of this trade? Asia. China and India don't look at U.S. jobless claims. They don't care what Powell or Trump said in Davos. They see physical metal being sold at a discount, and they are taking it. Huge premiums to the world price persist on the Shanghai exchange. It works like a giant vacuum cleaner. Metal is sucked out of London and New York and flies to the East, never to return. The self-made trap. This is a trap the West built for itself. By manipulating the price through futures and keeping it artificially low, we are effectively subsidizing the industrial and military power of our competitors. We are selling them a critically important component for their missiles and solar panels at a marked down price. We are giving away the family silver for cut paper that we ourselves are devaluing with inflation. The Greenland crisis that scared the markets was not an accident. It was a symptom. Trump's ultimatum to European allies regarding Greenland showed that the fight for resources has entered an acute phase. Globalization is dead. Now every superpower is trying to fence off its resources. And although tariffs were canceled, the signal was heard. Supply chains are no longer safe. China has already introduced strict export controls. They are fragmenting the market. What is mined in China stays in China. And what the West foolishly sells on the COMEX exchange also goes to China. We are in a state of economic war where silver is ammunition. And right now, the West is voluntarily disarming itself, selling its stockpiles because algorithms on Wall Street said sell. The irony is that this bearish correction we saw after Davos is the best gift for strategic buyers. Speculators left, fearing the disappearance of the war premium, but the industry didn't go anywhere. Military factories didn't go anywhere. Their demand is only growing. We are seeing a transition to a war economy where it is not the price of the asset that matters, but its physical availability. When the dust settles, the West will find its vaults empty. Asia will control not only electronics production, but also the raw materials for it. And then the price will no longer be determined in London or Chicago. It will be dictated by those who have the metal. And believe me, they won't sell it to us for cheap dollars. Part 4.4. The verdict. So what does all this mean for you personally? While analysts argue whether there will be a soft landing for the US economy with 5.4% GDP growth, or if we will see a new spiral of inflation, time is running out. The window of opportunity is slamming shut. Now that the price has pulled back below 92 euros, many retail investors have fallen into a stupor. They are waiting to see what happens next. They are watching TV, waiting for a signal. But when the signal is given on TV, it will be too late. Look at the forecasts of those who actually manage money, not just talk about it. Citi expects silver to break $100 by March of this year. Goldman Sachs raised its gold forecast to $5,400, which automatically drags silver above $110 per ounce. The LBMA forecasts a doubling of the average price. These aren't just numbers. This is a warning. $100 per ounce is not a ceiling. It is simply the next psychological marker that we will blow through just as easily as we blew through $50. Because a deficit cannot be closed with printed money. You cannot print an ounce of silver. It must be mined. And mining is falling while demand grows exponentially. Right now, we are seeing a classic passenger shakeout. Smart money is using this volatility to shake weak hands out of the market. They want you to sell your positions. They want you to believe that the strengthening dollar is forever. Do not give in. Look at the retail investors. They continue to buy, ignoring the correction. They feel in their gut what analysts cannot calculate in their spreadsheets. Paper money is losing trust. If you hold your savings in dollars or euros, you hold the debt of bankrupts. If you hold physical silver, you hold an asset without which the modern world stops. The final strategy. There are few scenarios. The base case is consolidation around $90, $94 in the coming days. This is a breather, a chance for those who missed out. But if we see new geopolitical shocks, and we will, or if the Fed even hints at weakness, the price will instantly fly to storm $100. Don't wait for news on CNN. Don't wait for permission from a financial advisor. Act now. If Russia and China are buying metal, preparing for a technological blockade, you should be doing the same on the scale of your family. Rescue your assets from the digital illusion. Convert them into physical reality. The economic iron curtain is descending. The world has split into two camps, those who print candy wrappers and those who extract resources. You must decide whose side you are on. While Washington plays politics and Wall Street plays the casino, the real world plays by the laws of physics. And in the end, physics always wins.